origin of the price movement becomes highly important. It shows that the supply area that created this movement is not an ordinary level but an influential zone in the market structure, so these supply areas are considered valid order blocks. Here we see an upward trend in motion. This marks the most recent structural break, confirming that demand remains dominant. Each of these demand zones presents a potential long opportunity. However, it's crucial to note that the starting point of this bullish move holds the most value and offers the strongest trade setups. There's a strong possibility that the remaining zones fall prey to a liquidity sweep. That's why it's essential to apply reduced risk when executing trades in such areas. Always keep in mind, while a solid trading strategy can grow your account, a proper risk management plan is what keeps you in the game. You can risk around 2 to 3% of your capital per trade and limit yourself to a maximum of 3 open positions at once. Let's move forward now and dive into the next concept, breaker blocks. A breaker block is an invalidated order block that transforms into a new supply or demand zone on the chart. According to basic price action principles, when price breaks above a resistance level, it often flips into support due to trader behavior. Similarly, when price breaks below a support level, it typically acts as resistance once revisited. This exact concept also applies to order blocks. The market may overlook a supply or demand order block for several reasons, such as a shift in market structure, being overvalued or undervalued, hitting a major level on a higher time frame, and more. When a valid demand order block doesn't hold and price breaks below it, it shifts into a supply zone. This is referred to as a breaker block, where we expect potential rejection from the market. Now, in this example, here's how a bearish setup might appear. We get a structure break above this recent high, along with inefficiency. That movement forms a valid order block zone, presenting us with a possible long entry. But then the market shows a shift in character due to a strong bearish move breaking below the prior low. This signals a change in directional bias to bearish, turning our former demand zone into a supply level. The psychology behind breaker blocks is that traders who went long from the order block are now trapped after the bearish structure shift, and they'll likely wait for price to return to their break-even point to exit without loss. At the same time, new sellers will enter short positions at this level, viewing it as a major supply zone. This combination of actions is what causes price to reverse from this area. The final concept we'll cover is market structure. Market structure involves swing highs and lows, supply and demand zones, order flow, and the general state of the market. There are 2 types of market behavior, trending markets and ranging markets. In an uptrend, as the name suggests, the market moves towards the upside, creating new higher highs and higher lows. Here you see an ideal ascending structure. The ideal means that the market respects the lows and continues pushing upwards. The important point is that in the uptrend, the market has a greater tendency to break the highs to the upside, although the market might not always move this clearly. This is the general definition that is commonly seen in the market. Even if you look at the 1-minute chart, you can see that the upward movement is created by making higher highs and lows, so as long as the price continues to break the structure levels to the upside, we are still in an uptrend. Now that we've discussed breaks, let's explore what a break truly signifies and the criteria we look for in a structure break. But before anything else, this is the basic anatomy of a candlestick on the chart. They may vary in shape and size, but they become crucial when discussing breaks and liquidity concepts. Structure and liquidity are 2 elements of the market that cannot be separated. Many liquidity zones gain relevance through structure, and numerous structure levels lose validity without liquidity concepts. It's something that can be challenging to grasp. But we'll break it all down today. So, how does a breakout actually happen? A breakout takes place when a candlestick's body decisively moves beyond the previous market structure. This means if the price closes noticeably, by a few pips, above the prior level, it qualifies as what we refer to as a break of structure. But here's a key point. How do we confirm that this break is genuine and not simply a liquidity sweep? In the event of a fake out or liquidity sweep, the price quickly returns back within the previous range. So, let's elevate our concept. If the price wicks above the prior market structure but ends up closing back within the range, we don't have a valid breakout, as explained earlier. To confirm a legitimate break, the next candle must close higher than the previous one. This clearly signals that sellers failed to drag the price back into the range and buyers have taken control. Likewise, a second confirmation of a break of structure with a closed body is to wait for the next candle to break above the previous candle's highest point. This suggests strong upward momentum, not just a liquidity sweep. Keep in mind, everything we've covered here also applies in reverse for a bearish scenario. Now, let's move forward to the next concept, reversals. As we touched on earlier, the market typically exhibits 2 types of behavior, trending and ranging. At times, it can be challenging to determine the market's direction, or it might seem like price is just moving within a confined zone. Since ranging markets are beyond the scope of this video, let's zero in on how an uptrend transitions into a downtrend and the reverse, in other words, a market reversal. When should we lean toward a bullish or bearish outlook? As discussed earlier, a shift in market character happens when the origin point is broken. A breakout takes place when a candlestick clearly closes beyond a key level in the market structure. Therefore, our first step is to pinpoint these origin areas to accurately identify potential reversal zones. But here's a key point, time frames play a significant role in recognizing a change in market character. For example, both of these zones qualify as sources since they've broken past prior market structure. However, we wouldn't treat this as a valid character shift. That's because the breakdown of such a minor move shouldn't be interpreted as a full trend reversal. So, here's another guideline for confirming a change in character. A valid change of character happens when the price drops below the lowest point of the latest impulsive move, which must be at least half the size of the previous one. For instance, take a look at this chart. Using market structure concepts, we can identify 3 impulsive moves like this. Each created a new high, so a break below the source of any is seen as a change of character, but notice the third impulse, it's barely half the size of the one before it. So in this case, if the price breaks below the swing low, we won't treat it as a valid change of character. Essentially, we compare the scale of the most recent impulsive move with the previous one, and it must be at least 50% of the prior move to count as a legit reversal. For example, if the last impulse was 40 pips, the current one needs to be at least 20 pips. Anything less, and we can't confirm a valid shift in market direction. Here in the bearish scenario, these are our impulsive bearish movements. Breaking above this level is considered a valid change of character because the impulsive move is clearly larger than half of the previous one. Always remember, we compare the most recent impulse with the one that came right before it. Regardless of your entry strategy, aligning your trades with the dominant market direction significantly boosts your win rate and improves your risk-to-reward ratio. Always remember, before running any setup on a real account, make sure to backtest it across multiple pairs using historical data. This helps you evaluate the true performance and reliability of your strategy. We do a lot of backtesting too, but let's be real, it's time-consuming. Still, it's the key to building solid confidence and consistency in your trading game. One of the most crucial concepts for identifying trends and potential reversal points on the chart is liquidity. Understanding where liquidity is resting helps us anticipate market moves, trap zones, and smart entry points with higher accuracy. When discussing liquidity, it's important to note that it generally pulls above recent highs and below recent lows. If we consider these zones in relation to market structure, price often dips below a recent low to grab liquidity before continuing higher to sweep liquidity above the recent high. In most cases, this liquidity sweep serves as a fuel source for trend continuation. For instance, in a bullish market, price typically sweeps liquidity below swing lows to accumulate orders, then drives upward with renewed momentum. Candlestick formations play a crucial role in identifying liquidity sweep movements. A long wick at the bottom of a candlestick typically signals a liquidity grab, especially when it breaks below a well-established support level. This area often holds clustered buy orders and stop losses. When price pierces this zone with a sharp wick and quickly rejects it without forming a significant upper wick, it indicates a strong buy-side reaction. This behavior suggests that institutional players may be absorbing liquidity before initiating a bullish move. However, it's important to note that price action isn't always mechanical. Each scenario should be evaluated within its broader market context. What we ideally want to observe during a liquidity grab is a wick that penetrates decisively through a key level, such as a previous support or resistance, and then quickly rejects back. For the move to be considered valid and meaningful, the wick should be at least half the size of the candlestick body. This demonstrates that the market aggressively pushed beyond the level to trigger stop losses or collect liquidity, but buying pressure, or selling pressure in a bearish case, stepped in with force, causing a sharp rejection. This type of price behavior often precedes strong reversals or continuations. Previously, we highlighted that a valid trend reversal typically requires the break of a source level. However, when liquidity concepts are combined with market structure, a liquidity sweep above a recent high can also serve as an early sign of potential reversal. For instance, if price sweeps the liquidity above a recent high, especially the one responsible for breaking structure to the upside, but fails to continue higher or form a new high, this signals possible exhaustion of bullish momentum. It's crucial to distinguish this from a liquidity sweep that aligns with the dominant trend, which often leads to continuation. A sweep against the prevailing trend indicates a shift in market sentiment and can act as an early warning for trend reversal. This nuanced difference is essential for refining entries and managing risk. Grabbing liquidity above a recent high typically signals a temporary reversal. It shows that the market has targeted stop losses or pending orders clustered above that high. However, we don't assume a full trend reversal based solely on this liquidity sweep. A true, confirmed reversal occurs only when the price breaks and closes below the most recent origin point, the structural low that initiated the previous impulse move. Once this origin is broken, it indicates that the bullish structure has failed, confirming that the uptrend is over and the market may now continue in a bearish direction. The same concept applies in a bearish scenario. A liquidity sweep below the most recent low often signals a potential short-term reversal within the dominant downtrend. From a price action perspective, this suggests that sellers have failed to establish a new low, indicating a loss of momentum. If the price quickly re-enters the previous range after the sweep, it shows early signs of bullish pressure. This upward momentum can drive the price toward the next visible supply level. However, a true trend reversal is only confirmed when the price breaks and closes above the origin point, the structural high that led to the last bearish impulse. This marks a valid change of character and shifts the bias to bullish. On the 5-minute chart of gold, the market sentiment is strongly bullish, consistently forming higher highs and higher lows. Notably, the presence of equal lows indicates a significant liquidity pool. These equal lows act as the source for the most recent break of structure, suggesting that a liquidity sweep at this level could serve as a potential signal for continued upward momentum. Therefore, a liquidity sweep pattern forming at these equal lows serves as a strong signal for bullish continuation. Conversely, if a liquidity sweep occurs above a recent high, it often indicates a potential short-term reversal, suggesting the current bullish momentum may be weakening. This reversal is confirmed when the price breaks below the most recent source point that initiated the break of structure. At that point, a directional shift becomes likely, and the market may continue pushing downward. Practicing these concepts directly on your charts will significantly enhance your technical analysis skills, deepen your understanding of price action, and help optimize your trade entries. If you found value in this video, be sure to like and share your support. And if you're new to the channel, consider subscribing for more insightful trading content. See you in the next episode.